As Wendell said when we kicked things off, we designed our strategy and capital allocation framework to create significant value for our shareholders by focusing our portfolio and utilizing our financial strength. My role in the execution of the framework centers largely on ensuring that Corning continues as a good steward of capital. I take that responsibility very seriously and am pleased to be able to reiterate that we are on track, having already delivered significant cash and enhanced value to shareholders. You will see that as we move through the second year of the framework, we are doing what we said we would do when we introduced the plan. We are delivering on our commitments. We said we intended to generate more than $22 billion and return more than $10 billion to shareholders. Now, we updated the framework in June of 2016 to recognize significant progress across multiple fronts, including the Dow Corning realignment. Now we expect to generate and deploy more than $26 billion through 2019. We also raised the lower bound of our commitment to shareholders returns to more than $12.5 billion over the 4-year period through repurchases and dividends. And we remain solidly on track to meet these goals. And we still intend to invest approximately $10 billion in growth and sustained leadership during the 4 years of the plan. Our capital allocation plan describes the sources and uses of the cash we plan to deploy through 2019. Now, I'll address the sources of cash first, focusing on the most significant, operating cash flow. Now, we remain very confident in our ability to generate adjusted operating cash flow of $13 to $16 billion over the 4 years, excluding after-tax RD&E. Now, our confidence stems from our results, the strengths of our businesses, and their growth prospects. In 2016, we generated $3.2 billion in line with both our expectations and what is required to reach our $13 to $16 billion target. Now, looking at the final two sources of cash, we will sustain our continuous effort to improve the efficiency of our balance sheet, and we expect to add debt before 2019. Now, transactions represent another source of cash. In mid-2016, we realigned our ownership interest in Dow Corning. As we've discussed previously, under this largely tax-free transaction, we exchanged our 50% ownership in Dow Corning for a company that owns a 40% interest in Hemlock Semiconductor and $4.8 billion in cash. In addition to the upside from Hemlock, this transaction added $4.8 billion in cash to our balance sheet, the equivalent of approximately 30 times the annual equity earnings of Dow Corning's silicones business. The freedom to deploy that capital is a tremendous value driver for our shareholders. Now, we are pleased with the structure and performance of our portfolio. We are well aligned with 80% of our resources focused on our 3-4-5 framework. In addition, each of our businesses is consistently beating its competitors, and we see future synergies and growth. Taken together, our certainty in generating $26 to $30 billion remains high. Now let's look at how we will use that cash, starting with our plan to invest $10 billion in our growth and sustained leadership through RD&E, capital spending, and M&A investments. Research, development, and engineering are critical to sustaining and extending our leadership positions in our markets. From 2016 to 2019, our plans call for us to invest a total of $2 billion, and we're on pace from both an investment and a results perspective. Now, our goal in RD&E are to create the best products, deliver the lowest cost, and create new revenue streams. Measures of our success include our market share, our customer relationships, and operating margins twice as high as our competitors. We believe that our focus and ability to repurpose our assets and reapply our talents will continue to enhance returns on our innovation investments. Over the last few years, we've invested in RD&E at double the rate of our peers. Between 2012 and 2016, on average, they've invested 4% of sales, while we've invested 8% of sales. But we have delivered more than 2 times the operating margin, or 20% versus their 9% average. Or said another way, our additional $2 billion investment in RD&E returned an additional $5 billion over a 5-year period. That is a huge premium. Turning to CapEx, we are investing in manufacturing capacity and capabilities in line with our plan for $6 to $7 billion in capital expenditures over 4 years. We spent $1.1 billion in 2016 and anticipate spending about $1.5 billion this year. Now, we expect our return on invested capital to increase as we continue to reuse and repurpose assets and secure co-investments from others. Because capital efficiency is a high priority, we are now linking executive compensation to improvements in ROIC. For acquisitions, we look for opportunities to gain strategic advantage by strengthening our portfolio or increasing our market access. Now, the framework anticipates opportunistically investing $1 to $3 billion on these type of strategic transactions. During 2016, we invested about $300 million on several small but strategic transactions in the optical communications business. Now, finally, let me get back to cash return expectations under the framework. We plan to return more than $12.5 billion to shareholders through share repurchases and dividends. The value of this activity equates to an annual cash payout yield of about 10% over the 4 years of the plan. Now, through the first quarter, we've already returned more than $6.5 billion to shareholders. And we intend to return at least $6 billion additional dollars over the remainder of the program, which is about a quarter of our current market cap. Now, the board increased our dividend 14.8% in February on top of a 12.5% increase last year. And we intend to increase the dividend by at least 10% in both 2018 and 2019, which means our dividend per share will rise in total by more than 50% over 4 years. Now, repurchase activity since we announced the framework has been approximately $6 billion, reducing outstanding shares by about 24% through the end of the first quarter. In 2017, we plan to continue repurchasing shares, reflecting our view that investors have not yet fully incorporated our growth prospects into the stock price. The key takeaway is that we are investing $10 billion to drive growth and extend our leadership. In the meantime, we are rewarding you by returning more than $12.5 billion, which compounds the benefit of our future growth for long-term shareholders. I'd like to finish off by summarizing our expectations. We expect optical communications to reach $5 billion in sales by 2020. We are enabling next-generation networks, and our customers are benefiting from our unique set of capabilities. And to support them, we have the ability to economically expand capacity and deliver innovative solutions. Consequently, we expect to grow significantly faster than the optical markets we serve. In our mobile consumer electronic market access platform, we believe we can double sales over the next several years despite maturing smartphone unit growth. Our close relationship with customers enables us to work jointly with them on compelling new mobile consumer products. We have a clear path to capture more value per device, gain share in developing markets in the value segment, and win in new device categories. In display, we are very pleased with our market position and our progress towards our long-term objective to stabilize returns. Cash flow remains strong, and you saw that we're well positioned to win in new display categories by innovating for the next generation of displays. And in the automotive market access platform, we're helping customers build cleaner, safer, and more connected vehicles. In the near term, we expect sales growth from the new gas particulate filter business. And longer term, we are building a gorilla-sized business for automotive glass. And in our life science vessels platform, we will continue to beat the competition and grow faster than the markets we serve. In addition, we remain enthusiastic about the long-term, multi-billion-dollar opportunity in pharmaceutical packaging for drug storage and delivery. Now, we are making great progress against all of these objectives. The best news is we don't need to win everywhere to deliver on our framework commitments. But if we do, we'll create even more value for shareholders. So what I want to leave you with is this. We have 5 powerful market access platforms. We are beating the competition, and we intend to keep beating them through innovation and lowest cost manufacturing. We have highly relevant, best-in-the-world capabilities that we can leverage to capture attractive new opportunities. And we're executing as we said we would. And we are confident in our ability to continue to implement and deliver on all aspects of the framework.